Hi, everybody. Welcome. Hope you're having a good day so far. Really excited to host today's market update webinar. We'll just give it a minute to let participants trickle in, and then we will go ahead and get started. The weather's finally starting to warm up a little bit in the DC area the last couple of days, which has been really nice. A little bit more overcast today, but it looks like it's going to get up into the 50s, low 60s. So hopefully you can get outside a little bit. We will try to do the same. So we've allotted for an hour today for this market update, and we're gonna, as usual, make sure that we leave the last 10 to 15 minutes open for question and answers, Q&A. So just a quick reminder, housekeeping, if you go to the Q&A button at the bottom of your screen, you can click on that and you can submit that either showing your name or anonymously, whatever you prefer. But any questions you have, please put it there. Jeff is on the webinar along with other 4J team members, and they will make sure that question gets addressed and answered as part of this webinar. Just to make sure we're okay on technology issues, if you guys wouldn't mind doing a hand raise or mentioning hey in the chat if you can see and hear me, see the screen. All right, it's looking like we're good there. All right, so we're going to go ahead and get started. This is a Q1 2024 market update by 4J Wealth Management. And you can see on the right there's your Wall Street Bull. Because we're going to try to make this relevant to what's going on in the world, that's actually an Adobe text to image AI created Wall Street Bull. So that was done completely by AI, put in some text that was created in Adobe very quickly. We'll more on that later, but we just wanted to kind of tee that up for you. What we're going to cover today is the year-to-date asset class and sector performance. We'll talk about what's behind this momentous stock market rally that we've been experiencing the last 14 months. We'll talk about current valuations in the market, right? How expensive or cheap is the market? Talk about one of the big themes from 2023, which is AI, or artificial intelligence. We'll talk a little bit about the bond market, where we feel like there's some good opportunities in bonds. We'll finish with the Fed, inflation, and interest rates, and then we'll go to Q&A. More AI for you here. This is just Old Town Alexandria, King Street mentioned, and the AI Adobe came up with these images. So we thought we would include them here just to give you a sense as to how powerful this technology is. So hopefully you enjoy those. We thought they were kind of pretty and colorful. As always, we have to mention important disclosures. Anytime we're talking about past performance or returns, there's never a guarantee that that's going to continue in the future. So past performance is no guarantee of future results. And as always, this is for informational purposes only. You should not look at this as investment advice or a recommendation for your particular circumstances. That should always be discussed with us on an individual basis. Okay. All right, so let's start with the year-to-date major asset class performance. So we're on the far right, you can see the year-to-date performance of various asset classes, which are color coordinated, but then it also goes back all the way back to 2009, right after the great financial crisis. And you can see each of these years has these boxes under them, and these boxes represent different asset classes. So if you're looking at 2009, that light purple is emerging market stocks, okay? The kind of turquoise blue is high yield, meaning high yield bonds. DM equity is developed market equity. REITs are real estate investment trusts. Small cap or small cap stocks, meaning small stocks, not big companies, but small companies. Large cap stocks, that's like the S&P 500. Commodities, precious metals, for example. Then you have broad fixed income, and then just cash. And the big thing, I'm going to point out two things here. One is if you look back over the last kind of 12 years, in 80% of those years, large cap equity, or the S&P 500, has been in the top three, really top 3 or 4 all of those years, except for maybe 2022 when it was down 18%. And we don't know whether that trend is going to persist. It did last year. It's currently leading the charge year to date. But we think a big driver, and we're going to talk more about this, is that in the 2010s and into the 2020s, technology companies, the rise of tech has just been incredible, right? You had companies like Facebook, now Meta, that didn't exist in 2000. It wasn't even public until 2012, wasn't making any money in the late 2000s, and now is generating tens of billions of dollars of free cash flow every year. Okay. And it's the internet, it's social media, it's all these things that have changed the way we interact with the world. And tech has kind of been the tip of the spear for that. On the far left, this is, I think, a little bit of a more instructive perspective. It looks at the annualized, or the per year average returns for each of the asset classes, through this entire time period, 2009 to 2023. And then on this right column is vol, or volatility, which is a measure of risk, right? How much on average, does the range of outcomes relative to these averages up or down, right? So the higher the volatility, the higher the risk. And there's the two asset classes that jump out to us as having really good risk reward characteristics, which is a theme you're going to hear a lot in this presentation, because it's how we think about investing. Is one, large cap US stocks, right? They've averaged 14% per year over this 14-year time frame. And then look at the risk, 16.1. So it's almost 1-to-1. And high yield is another one, 9% per year almost, and 11.5% standard deviation, almost 1-to-1. Compare that to something like real estate. It's had a good return, 11%, but the risk has been 2-to-1, right? You'd have to, risk of 21.2% to get a 10% return. That's not as attractive. Same thing with small caps. So, we're always looking for, how much return can we get for the least possible amount of risk, especially relative to other alternatives. Now, more specifically, year to date, looking at just the sectors in the market, you can see, right, the market as a whole, if you're just looking at the S&P 500, it's up about 6 to 7% year to date, right? So you've almost gotten a year's worth of returns in 2 months, okay? And the market doesn't move in a straight line, as we know. But when you look under the hood, communication services, by the way, 50% of that is concentrated in Alphabet and Meta, literally Google and Facebook, for people who are more familiar with those names. So those companies have done extremely well year to date. And so that sector is up almost 12%. Technology more generally, right, up 10%. So you have these very big concentrated positions that are pulling the average of the market up as a whole. But most of the market, right, industrials, staples, energy, utilities, they're actually kind of just plugging along. And in fact, something like utilities has been lagging the market. And when we look at this type of a spread, we see it as opportunity in certain parts of the market. Why? Well, utilities are trading right now at about 15 times next year's earnings. The market as a whole is trading at 20 times next year's earnings. So it's trading less expensively than the market. And utilities are paying about a 3 to 4% dividend yield in aggregate. And they're able to grow their earnings without much cyclicality in the mid-single digits, 5 to 6%. So you're looking at over a multi-year period, an 8 to 10% return, anticipated in something like utilities with less cyclicality and less risk than the overall market. Very appealing, right? Out of favor now, right? Everyone wants the AI, but very interesting if you're looking out over a longer time frame. And let's be honest, when we look at the transition to renewables, we talk about AI, we talk about cloud computing, all of these things require massive energy consumption. All these data centers, massive energy. Utilities are going to have to power that. right? They're going to have to build the infrastructure. They're going to have to eventually pass on those costs to customers and businesses in order to make this dream a reality. So kind of a sleeper long-term winner, we think, as the AI continues and the green revolution continues. All right, let's continue to look under the hood. So here's, you probably heard the moniker, the Magnificent Seven, right? It's basically the 7 largest companies that are publicly traded right now. So it's the big ones we've heard of. It's Apple, it's Amazon, it's Microsoft, it's Meta, it's Nvidia, it's Tesla. Okay, so it's these really, really big technology companies. And what's fascinating to us is if you go back not even that far, 8 years, and you look at those 7 companies and how they've done, and then you compare it to indices that have also done really well, right? The S&P 500, the NASDAQ, okay, the European stocks, it's not even close, right? I mean, it's the same reason why those large cap US stocks have dominated. You've had this rise of technology that has just dominated every other sector and industry, okay? And so that's more of what you're seeing here. And the question is, we are still very early in the AI days, right? We're like in the bottom of the first inning. The majority of companies are just beta testing. And we'll talk more about this, but they're beta testing, they're running models, they're doing internal tests on AI and how it could be used, right? But the market is extrapolating all sorts of, who are going to be the winners, who are going to be the losers. But like anything, we're not going to know for some time, right? So the market's pricing a huge optimism on these Magnificent Seven. They will be probably very big beneficiaries if you look at it, but the entry point for those companies is a lot higher today than it was 5-10 years ago. Frankly, even 2 years ago. Look at this decline during the inflationary, when we had the kind of surge in inflation and interest rates, tech companies got crushed, right? You had a great buying opportunity here, and they've surged since then. But it's not like they were immune from going down. In 2023, almost all of the growth in company earnings was driven by the Magnificent Seven. Kind of incredible, right? So you look at the market, it did great, but it's really driven by, these 7 to 10 companies that have just had incredible growth on the backs of, AI and AI spending. And the big one, the big one is Nvidia, right? I mean, that's the elephant in the room. They essentially have a monopoly on the GPU chips on which all these AI large language models run. That is expected to continue for most of 2024, right? You have the Magnificent Seven, which is driving majority of earnings growth. And then not until the fourth quarter is it expected that the other 493 companies start to, come from their inflection point at the bottom and start to really grow in a meaningful way. We'll see if this plays out, but the story so far in 23 and into 2024 is the Magnificent Seven are driving everything. And for the market to really continue to run and go up, the rally has to broaden out to these other 493 companies. Okay, so this is looking at the valuations, okay, of the market, but slicing it and dicing it differently so we can kind of see what's going on, right? If you look at the S&P 500 in the tech universe specifically, right? So this is the Magnificent Seven plus other technology companies. You can see it's trading right now. This is a measure of how much you're willing to pay, the price for $1 of profits. And the market is willing to pay almost 29 times next year's dollar of profit for these technology companies, which, relative to its average over the last 20 years is elevated, right? Average has been, or the median's been 21.6. It's at 29. At the bottom of the financial crisis, it was down to 12. It's a buying opportunity of a lifetime. Now, a couple things to note. We are not anywhere near the frothy levels that occurred during the dot-com bubble. That's a good thing. The only other time we kind of got above this 30.9 range was during the COVID craze, where everyone was stuck at home and technology stocks were going through the roof. That kind of retraced, and now it's come back on the heels of AI. The point here is, yes, it's elevated. Yes, valuations are extended, but not for no reason. These companies are more profitable. They have incredibly dominant business models. They have very little debt. They have a ton of cash on their balance sheets. All these things, it's reasonable that the market would say we're willing to pay more for these earnings than the market as a whole. Nevertheless, it is at the higher range where you want to be a little bit more cautious. Now, if you look at the rest of the market, kind of the S&P 493 or S&P 500 X Tech, it's trading much, much more reasonably. In fact, it's in line with the 30-year average of about 17. So we think there are more opportunities, and we kind of talked this in healthcare, utilities, for the rest of the market relative to kind of a tech-only market. So we think of it kind of the tale of two markets, right? You have the tech-dominated market, which is trading at a big premium to the market, right? And then you have the rest of the market that's kind of in line, and some of these sectors are actually below their long-term averages in terms of valuation. Okay, this slide is interesting, but it's a little bit more technical. So I'll try to make it clear. What this is looking at is going back to 2008, so about 15 years. The proportion, okay, of sector exposure in small cap stocks versus large cap stocks. Okay, small cap stocks versus large cap. So small cap stocks are small companies that are publicly traded, right? 1 billion, 2 billion, 3 billion, 5 billion. Large cap stocks are trading 20, 30 plus billion and up, right? The big companies you've heard of. Now, what's interesting is industrials have been pretty consistent, where there's an equal kind of exposure between small companies and large companies. But what's really kind of shocking to see or surprising is how much things have changed with technology and energy, right? Energy was a much smaller component of small cap stocks, and now, right, it's gone from -8 to actually a slightly positive relative to where it was. Technology, on the other hand, in the small cap universe, has gone from effectively neutral to now almost 20% less than it was 15 years ago. So what this means is that small caps have lagged greatly because the rise of technology, right, has been kind of focused in that large cap arena. And it's also made the small cap kind of stock indices, the Russell 2000, the S&P 600, much more cyclical because it has more concentration in industries like industrials and energy, which tend to be more cyclical with the economy. Now, technology can still be cyclical, but it generally is less cyclical than those more highly cyclical industries, okay? So it just shows you how much the world has changed over the last 15 years. So let's take another look at the stock market valuation. We kind of parsed the data looking at tech versus non-tech. But if we just look at the market as a whole, as of last week, it's trading a little bit over 20 times next year's earnings, right? Not at the levels it was during the COVID, the COVID highs or the tech bubble, not even close to that. But it is elevated. Now, like I said, right, it's 20 times next year's earnings, but you can't look at that just in a vacuum and say that's expensive, okay? Well, it is expensive relative to history, but it's all predicated upon, right, this is the price you're paying for $1 of earnings. Well, what's going on with earnings? And with earnings, if you look at the S&P 500 profit margins, the market constituents as a whole are a lot more profitable today than they were 20 years ago, right? If you look back into the early 2000s, or even mid 2000s, you're looking at 7, 8, 9% profit margins. Well, more recently, they're at like 11 to 13%. So the quality of the companies and how profitable they are, largely because of technology, is actually increasing. And so you could say, well, the market is being somewhat reasonable here, saying things should be more on the expensive side because we have better quality earnings that are being generated by the companies, okay? So again, anytime there was another theme here that isn't mentioned explicitly is that yes, AI has been a huge driver of the 2023 and 2024 returns, but we also had a massive reversal in the sentiment of the market from 2022. That's another huge component here. I mean, every economist, analyst, portfolio manager, bank, everyone we read or talked to in 2022, including us, we were scared, right? We were scared because inflation was surging. We hadn't seen that in 40 years, but the bottom was everyone was calling for a recession, right? Everyone was calling for a recession. Then it became, well, the recession is going to be delayed. Then it was, well, it's going to be a hard landing. And now it's, well, we're going to have a soft landing. So yes, the quality of earnings are higher, which justifies a higher multiple. Yes, technology companies are a bigger portion of the index, and they have dominant business models that are more profitable. All that's true. But sentiment has swung wildly from very negative to very positive, and that's always something we keep an eye on, and we try to lean against that a little bit, okay? Try to lean against that, because anytime after the market's risen 20, 25%, we believe that the risk is higher and future returns are generally lower, okay? Conversely, when the market falls, risk is actually lower, okay? And future returns are higher. The problem is these things don't happen in a vacuum. When the market falls 20, 25%, it's because something's broken in the world, or the market's really worried. 2022, it was inflation, it was interest rates going from 0 to 5, and the Fed crippling the economy. Okay, in 2018, it was the China trade wars. In 2020, it was COVID. There's these events that happen in the world, and the market can't see past it. It gets entrenched in, oh my God, we can't see past the next 3, 6, 12 months, and it just sells off, right? And that's the opportunity. But it's also really hard, very, very hard to kind of lean into those things. And that's where, you have people like us who can, do that for you, and frankly, put money with managers who do that for you. We already talked about the AI bull. Look, this is scary to a lot of people, and we recognize that. Artificial intelligence, I don't know if you guys have used ChatGPT at all. It is very, very powerful, and it's getting better all the time. And so, it is going to, over time, not this year, maybe not next year, but 3 to 5 to 10 years, it's going to cause, we believe, a huge amount of disruption. Okay. And we're going to give you an example of that in a second here. So let's talk a little bit about kind of the artificial intelligence ecosystem. First off, what is AI? Right, AI was a term first coined by a Stanford professor, John McCarthy, in 1955. And I'll just read you. He defined it as the science and engineering of making intelligent machines. IBM defined it as technology that it enables computers and digital devices to learn, read, talk, see, create, play, analyze, make recommendations, and do other things humans do. And we think that's a really good definition. And it's not ready to do all those things, but it's moving very quickly in that direction. So the AI ecosystem is many layers, and this gives you a little bit of a sense as to the players in the AI ecosystem. Right, and as you'll see, all 7, right, all the Magnificent 7 stocks are here. The market is not stupid, okay? It can be irrational, but it is not stupid. And you can see, right, NVIDIA has been the poster child for this movement. They essentially have a monopoly over making the GPU chips, and now they have a software layer on top of those chips. So, they've been huge beneficiaries. But you see Apple here, you see AWS, you see Microsoft Azure, you see Google Cloud. Right, you see AWS again at the data level, Google Cloud at the data level, and then some other players, Microsoft, OpenAI, right? That's the creator of ChatGPT. Oh, by the way, Microsoft owns roughly 50% of OpenAI, and so, right, all of these large language models have to run on, right now at least, GPUs, graphic processing units. Okay, NVIDIA is far and away the biggest maker and the best, and it has the best product in that area. A huge amount of compute power is required. Electricity is required to run these large language models. The biggest buyer of these NVIDIA chips is big tech. It's Apple, it's Amazon, it's Meta, it's Microsoft. okay, and it's Alphabet. That's what's driving this insane surge in their revenue of hundreds of percent in a year, okay? So, but it's still very early, right? Most companies are not really utilizing it. They are beta testing it, okay? They definitely are looking at it internally. They haven't rolled it out to customers yet. That's going to start in 2025, and then it's just going to pick up steam from there. So this is a kind of one of the ways that, and Jeff does a fantastic job finding these charts, but the mention of AI on earnings calls, right? It was not even mentioned at all. Look at 12, 13, 14, 15. It started to rise in 16, but still very small. And then look at the parabolic jump last year, right? Where the proportion of S&P 500 companies mentioning AI during quarterly earnings calls went to, up from 10 to 15 to 36%. Sometimes this can be a sign of a bubble, but while there will be bubbly parts of the market as a result of AI, there always will be, right? Companies that are profitless but have a great vision, people buy into it. But it's gonna be as significant, right, as something like the internet. Some are saying even more. But it's tough to know how it's all going to play out. The bottom line is it's becoming much more discussed, much more mainstream. There's a huge interest from analysts to talk about it, and companies are aware of that. So computational power now allowing for AI, right? So if you go back to the early days of the 90s, this is a logarithmic scale. So I apologize for some of the detail here, but basically you've heard of Moore's law, right? Compute power doubling every 2 years. You can see that blue line is really if we were to look linearly, it would be parabolic, but this is the logarithmic scale, so you can see it's kind of a line to the right. But look at what's happened. This is from NVIDIA. The GPU computing performance, you can see not only is it steeper, but it goes for longer, right? So they're talking about trillions of operations per second going up 1,000x in 10 years. I mean, we can't even totally wrap our minds around this stuff because it's so large. But the point is, it's going, through 2030, it's just going to be an incredible surge in AI and computing power. Conceptual kind of map, again, take this with a grain of salt, but you can see economic activity here in time. Once we kind of have this AI breakthrough and AI can self-sufficiently advance human knowledge across a wide range of domains, you get this explosive period of growth. AI can independently perform research and development work, which creates more economic output, which allows more resources to devote to better AI systems, allowing for bigger acceleration. This is what everyone's kind of buying into, is that AI is going to hugely improve productivity for workers. It is going to result in some workers who frankly will have to be retrained. We don't see a way around that. And again, this is not a next year thing, but it's a 5 to 10 year kind of cycle that is going to change, and there are going to be some very big winners. So what is that impact of automation and augmentation on the total workforce? So you can see on the left-hand side is where it's kind of expected to be the least. This is from Boston Consulting Group, the least amount of productivity gains, and on the right, the most, meaning you need less of these people over here. So customer service, accounting, legal and compliance, right? These are areas that definitely could be disrupted and have much bigger productivity booms. But again, that means productivity booms mean less workers are required. So not necessarily a great thing for society, but that's beyond our pay grade to figure that out. We're just trying to tell you what we think is going to happen here. But it's going to disrupt kind of everything. No one knows the extent to which it's going to do all these things because it's so early, but it's going to be big. It may even be bigger than what's being expected. So we wanted to play this for you. This is a Wendy's AI drive-through technology that is currently being in Ohio. So this is actually happening. With the AI, it's going to get smarter and smarter with repetition accuracy. So I'll just play this for you so you can get a little bit of a sense. This guy is trying to kind of confuse the AI and see whether the order is correct.
What would you like? Hi, can I get one bacon double stack biggie bag? What sauce for the biggie bag nuggets? Can I get barbecue sauce? Which drink for bacon double stack biggie bag? A Coke, please. Which drink for bacon double stack biggie bag? A Coca-Cola. Got it. Anything else? Also, can I get a Dave's Classic Single? Got it. Anything else? On that Dave's Classic Single, can I get no cheese and extra pickles? Would you like anything else? Can I get extra cheese, extra pickles on the Dave's Single? Anything else? Can I get no cheese on the Dave's Single? Accurate.
Okay, so right, you can see right there. I mean, this is, I mean, look, the writing's kind of on the wall. I mean, I think in 5 years' time, you're really not going to be dealing with when you drive through. If anyone still does drive-throughs in any of these fast food places, it's all going to be AI enabled at every single store because it's faster, it's more accurate, it's a better customer experience. You know, that's just the reality of where things are heading. But they're already all piloting it, and as soon as they have their case, you know, their case studies proven, they're gonna roll it out across the globe, and it's gonna improve margins. Okay, so let's move on to the bond market and bond market opportunities. Everyone's focused on stocks and AI, but we actually think we can be playing some offense right now in fixed income. Two areas that we like are high yield and bank loans. You saw on that chart I showed before, you know, high yield was one of those asset classes that had a really good return, right? Almost 9% per year on average over that 13-year period, and a standard deviation of about 11. So you're getting a lot of the market's return at a lower risk. And we think that story is definitely intact right now with high quality high yield. So we're not talking triple C, we're talking mostly double B, some single B. Current yield is roughly 7 to 8% on that higher quality high yield. And you know, a lot of companies still from COVID were downgraded from investment grade. So you still have companies that are in really good financial in a financial position, but are technically not investment grade, and we can get. Again, if we're thinking markets already surged here 25+% over the last 15 months, going forward, if you said, well, you know, what do you think the market's going to do? Well, we think it's going to do 7% over the next 3 years. We think that's reasonable. Well, if we can get 7% in high yield and take half or less than half of the market's risk, very appealing, right? That's that risk reward. And then the same thing with floating rate bank loans, right? Loans made to companies by banks. Those are secured by assets and are senior in the capital structure, so they get paid back first if something happens. Those are yielding a little bit higher, 9 to 10%. A lot of this relies on the security analysis done by the manager. It really is a case-by-case basis. This stuff is not all created equal, but we have identified several managers who we really like their process. We feel very comfortable with how they underwrite these companies and what they're looking for. And we think these are two areas where we could earn 7 to 8 to 9% without being in stocks, taking less risk than stocks, less volatility. And frankly, you know, even if you have a tough market, tough recession, defaults rise, we still think these would do well over a market cycle. So we think that those are very appealing. This just shows you that the yield on U.S. high yield and leverage loans, which are bank loans, you know, currently 8% for high yield, 10.5% for bank loans. This is their historical 10-year average. You know, we're avoiding really any emerging market debt or Eurozone high yield debt. We don't think we need to go there. We can get the diversification and quality of companies right here in the U.S. So So interest rates and inflation kind of depends on what you're looking at. How you slice the data will drive what you see. It's a Rorschach test, just as a kind of a fun way to say it really depends on how you're looking at it, which will drive kind of what you think. We hear, and I'm sure most of you out there feel like inflation is still very much a problem. Whether you go to the food store, right? Food, it's just, it feels very expensive. You want to go on a trip, you want to go stay in a hotel, you want to go get your hair done, services, it's still expensive, right? So the Federal Reserve has not hiked since the end of last year. So, everyone's kind of concluded that the Fed is done. And so what this shows you is what the market returns have been over various time periods after the Fed's last hike. And this current cycle is following the majority of these, with the exception of 1990 to 2000, where you obviously had the dot-com bubble, so it trended downward after that. But in general, after the Fed pauses, market does well, but it's not going to move in a straight line, and we don't know if this time will be exactly like the other times. So rate of disinflation is moderating, right? So this is a really good chart, I think, because it shows the annual inflation rate looking kind of going back 5 years and broken down by services, goods, food, and energy. And what you can see here is the summer of 2022, you had this massive surge in inflation. It peaked at almost 9%. I mean, there was panic. Clients panicking, Wall Street panicking, right? Now, from that time, what you've really seen, look at energy, right? The Russia-Ukraine war, but energy has come way back down. It's actually, declining more recently. People don't really focus on that. They focus on the food, but energy prices have come way back. That's right now. We'll talk about that. Goods, right? That inflation is totally undone, right? So the Fed was right about that. And then food, still increasing. Okay, it's still going up, but at a slower rate than it was. So it went up massively, and then it's kind of slowed its rate of increase, but still going up. The one that really has been stubborn is services, this orange category. That really is not, the rate of disinflation is not going down, it's staying level. And I think that's what's a little worrisome to the Fed. But the services stuff, that's everything I was just talking about. It's healthcare, it's hotels, flights, anything where you're eating out at a restaurant, that's all the services stuff. And it's been very sticky, very sticky. Energy, goods. Now, what's concerning to us is the services stuff, for at least the foreseeable future, is going to remain sticky. But energy, we could have an energy shock, and then if energy turns positive, now all of a sudden inflation gets back to some 4 to 5% or more, and that could be very uncomfortable. And higher energy prices will bleed into higher food prices too. So we did a ton of spending on goods during COVID, and then that kind of unwound. But services have continued to stay stubbornly inflationary. And we'll see, AI is over time probably going to help with some of that. But that's not any time in the next year or two. So what are the drivers of GDP growth, right? It's how many workers, growth in workers, and then the growth in the productivity per worker gives you the ultimate growth in GDP after inflation. So we would expect that the productivity part, the gray, to actually go up over time. The growth in workers is going to stay, very flat based on the demographics of the country. But that's where the whole AI thing could drive things. But this is what it's been, and you can kind of see the breakdown over different decades between. And this isn't before AI it was internet. Before the internet it was the car. Before the car, the airplane. So there's always these massively new technologies that come online. It just changes everything. It's a step function change. It's changing the way we do business, the telephone, all these things. So AI is the one that's today, but it's not like we haven't had these massive changes in technology over time. All right, Jeff, before we go to Q&A, is there anything that you want to add that I may have missed?
Oh, I'll just go back to that last slide real quickly, because I wanted to just tie that into rates, why it's in that section. And if we kind of go back and you just look in the 60s and the 50s, that growth in real output per worker, we call that productivity, or economists call that productivity. And the reason that matters is that, the workforce change is going to probably be in the 0 to 1% range. We're kind of a mature economy. That's, the workforce is the population growth essentially over time. That's probably is what it is. But the productivity shifting into a different gear as a result of AI potentially gets you to, maybe where it's been 1 to 1.5, maybe it's 2 to 3%, something like that. And so the idea is really, if you kind of add those two numbers together, let's call it, the potential GDP of the economy is going to go from 2 to 2.5, or maybe even up to 3%. And so now all of a sudden you tack on a couple percent of inflation, which the Fed targets 2%. Now you get kind of GDP growth at 5%. The 10-year Treasury should approximate somewhere around there. And so we saw, the 10-year Treasury kind of briefly head up to 5%. But then it went back below 4%, and now it's kind of slightly over 4%. So the only point here is really, if potential GDP kind of creeps up due to productivity boom from AI, we could see kind of longer term rates shift higher structurally. Pre-COVID, the 10-year was at 2 to 3%. It could be easily 3.5 to 4.5%, or 4 to 5%, kind of something we haven't really seen since the late 90s, essentially. So that was why that was one time.
Yeah, that's great. Thank you.
Okay, we do have a question.
Okay.
Says many stocks appear to be priced to perfection. Where are relatively undervalued opportunities in equity and debt markets?
Yeah, so I think we touched on that a little bit, but I think part of the undervalued opportunities, healthcare is an area, utilities is an area. I think parts of energy is an area. Within fixed income, that high quality, high yield, floating rate or bank loans. And then there are parts of technology that haven't really, they might be trading a little bit more expensively than the market, but specifically software companies. So you can think companies like an Adobe, Intuit, Roper, companies like that, this will be kind of what we think is the second derivative effect of AI, where software companies, their biggest component of their cost structure is computer engineers. Well, the biggest kind of test case we have right now is the GitHub Copilot, where AI is helping developers write code, and it's made developers 30 to 50% more productive. So what we're going to see over time is that the revenues of those companies increase, while their margins actually increase, because they don't need as many developers to write the code. And that's right now. If the productivity from AI makes them 100% more productive, well, now you need half as many workers, half as many software engineers, which dramatically lowers their cost.
Yeah, and I would just add on, if we just go back a couple of years when they're kind of developing the vaccine, you have to have a hypothesis, and then within healthcare, you have to kind of source all the compounds and kind of mix them together, and then you have to spend a lot of money kind of testing them out, putting together. AI is going to, there's estimates that AI is really going to impact parts of the pharmaceutical process and chain, which is kind of interesting, especially as kind of we have an aging demographic, at least in the United States. So there's the healthcare industry, I think, is very well poised to kind of take advantage, or at least be kind of on the positive side of benefiting from AI. So
Great, thanks, Jeff. Are there any other questions come in?
I do not see any.
Hopefully that's a good thing, means we answered all your questions, but
We've got one more.
okay.
If inflation remains sticky, should we anticipate the Fed raising rates or keeping them steady? Everyone's essentially thinking the Fed's done and the next step is cutting, but this individual's asking, is there a chance that they could go higher even?
I mean, there's always a chance they could go higher, but I think they're a lot more likely to just keep things where they are for longer to see how things play out. I think them changing the signaling on, hey, we're not really looking to cut anytime soon. The market's going to reprice based on that, without them having to raise rates. But I don't know if you have a different opinion on that, Jeff.
No, I think that's a good point. What we saw, if you look back into late last year, the Fed had kind of signaled a pause, or at least one more hike, toward the end of the year, which they did. But then what had happened when in November, we had kind of that benign CPI print, a couple other things mechanically happened within the Treasury market. But we saw actually rates peak at 5% and then come all the way back down towards the end of the year around 4%. So the Fed didn't really have to do anything at the Fed funds rate level for financial conditions to ease. And conversely, they could accelerate quantitative tightening. There's other tools in their toolbox to really keep the effective Fed funds rate at 5.5, not have to raise, but make financial conditions a little bit more tight. Sometimes they do that through the press conference with Powell, the language, their economic projections. So there's other ways for them to impact policy other than the Fed funds rate, although that has been, the primary focus, I think. But there's other ways for them to kind of essentially jawbone rates to be a little bit higher the longer end. So that would.
Good answer. Anything else?
Okay, good. Another one. Any thoughts on the likelihood of a government shutdown and how that might impact equity and debt markets?
I feel like this is every year the government shutdown concern. I think it'll have limit. I mean, I think last year people were really worried with some of the polarization in Congress that there would be a shutdown, and we kind of held and said, it will go to the last minute, but we think a deal will get done. Ultimately, the deal got done. The market went higher. I think it's probably going to be more of the same. There's no way for us to know. But I don't think there will be a material impact on the markets. I just don't.
Yeah, agreed. I mean, this is always something I guess, it's a legitimate concern, but it always seems to resolve itself. I'd just say it's also an election year, so I don't think anybody wants to put their neck on the line.
Is there any other questions?
Yeah, one more question.
Good.
It says, if you think NVIDIA is too high, what is there to buy in the AI space? So, NVIDIA has been kind of the primary focus, I think, of a lot of investors, but is there anything in the AI space outside of it that may be attractive?
Yeah. So real quick, before you jump in and answer that, I just want to give everybody a sense. So one of the, you all, if you've been working with us, know that we invest in a fund called T. Rowe Price Capital Appreciation. The fund is managed by David Giroux. He's been running the fund since 2006, and he's been in the 1 percentile across more, his peers for 5, 10, 15 years, 3 years. Incredibly good manager. And the reason I say this is because NVIDIA came up in his shareholder letter, which was released yesterday, And I want to give you guys a sense as to how he thinks about this stuff, because he does own NVIDIA. So I'm just going to read this to everybody, because I think that this gives you such a good sense as to the rigor behind that fund and how it's investing your money. Now, the question is, I'm reading this, who are the big winners of AI? In 2023, the market voted that growth companies will benefit. Many non-AI growth stocks were dragged higher as a result. And in particular, the biggest beneficiary will be NVIDIA, says the market. NVIDIA manufactures GPUs that enable AI application and has a virtual monopoly on those systems and semiconductors. NVIDIA's earnings will likely explode from $3 in fiscal year 23 to $23+ in fiscal year 25. NVIDIA is perceived today to be a pure play on the growth of AI and was the best performing stock of the Magnificent Seven in 23. While we own NVIDIA in your fund, there are still a lot of unknowns about how AI will play out for NVIDIA over the next 5 to 10 years. We have spent countless hours trying to get to the bottom of these questions with limited success. Those questions include, and this is what I want you to listen to, what will NVIDIA's share of GPUs be over the next decade? Today, it is close to 100%. Do competitors and custom silicone, parentheses, chips from cloud providers, displace a modest, moderate, or large part of NVIDIA's GPU chips between now and 2030? Number two, as we move from training large models with as many as 12 trillion inputs to training smaller models and doing more inferencing, can we do more of this on CPUs, which are much lower cost than NVIDIA's GPUs? Third question, how much do NVIDIA's margins need to come down over time as new competition comes into the market? And four, what will the size of the GPU market be in 2030? And his point is, while they own it today, there's a lot of outcomes that are very large, and he doesn't think it's the best risk-adjusted play from here because so much positivity is priced in. And this is the part that starts to answer your question. Where we are making our bet on AI is really in two areas, software and cloud computing. With these, the range of outcomes is skewed very positively, and we think risk-adjusted returns look very good and valuations are still reasonable. And he goes out to point out, so it's the company, Intuit is a really good example, right? The maker of TurboTax and QuickBooks, they have an insane amount of data, millions and millions of data on returns. And they've trained a large language model to look through that and help clients, help customers. That along with everything else they're doing across their portfolio, it's going to be huge, or could be huge. So Microsoft is obviously another big one. But I think the way it's not so much trying to find the next like AI winner because they're making a better chip than NVIDIA. It's trying to think through how the AI is going to flow through the economy, and where is the meat going to stick, right? Like the internet, everyone thought, oh, everyone's going to win. Well, no, most of that just trickled through to the consumer, and they had a cost savings, right? It didn't stick to the company. So the question is, where is the AI technology going to stick? And his opinion, which is going to be way more informed than us, is it's going to be in the software and the cloud computing space.
Yeah, I would just add to that. I mean, for people that haven't really followed this up until recently, I mean, NVIDIA was a GPU manufacturer, which is primarily used in gaming consoles and computer graphics for video games. And what happened was when AI started to get developed, they said, oh, hold on a second. We can use, if you think about playing a video game on a computer, like there's a lot of motion, a lot of change, all of that's happening as opposed to kind of a static screen like we see, kind of like what you're looking at right now, which is just a PowerPoint presentation. And so NVIDIA was kind of right place, right time for this technology, and they found their GPUs were really, really, really fundamentally what was needed to power AI. But it doesn't really, you don't have to really go back too far. I mean, most of the people on this call, probably the first computer that they bought was using an Intel microchip. And you can look at the two charts of those stocks, and you can see how it can happen, but it can also happen very rapidly, where one company comes in and really competes away the other's kind of first mover advantage. And so what Josh is going to point is here is, right now, sure, Meta's buying a ton of NVIDIA's chips, Apple, Microsoft, Google, but do they at some point kind of internally develop their own GPUs that pull away some of that demand from NVIDIA? So I think that we go back to that slide where we showed kind of the AI ecosystem. What everybody's focusing right now is that bottom base level of the pyramid, and understandably so, because it's the most tangible, right? Everybody's talking about the blocking and tackling kind of the AI move, which is the chips. But really, up the food chain, up to the application layer, that's when things going to get really kind of exciting. And it's really just hard to know what that's going to look like. It's probably several years away. But that's probably where a lot of the value is realized.
Yeah. Any other questions? Hopefully this was helpful and gave you a perspective on kind of what's happening and why the market is doing what it's doing, and not just to focus on kind of the return as a whole, but to better understand kind of what's driving it under the hood, and where opportunities are that a lot of people aren't looking. I think hopefully we help to answer that. But again, sentiment is very good right now. A lot of clients we have who, a very small number of clients where they've been kind of wanting to sit more on the sidelines. A lot more of them, if not all, have kind of said, hey, is it time to put money to work? And that's right. That's normally a sign. Doesn't mean the market can't go higher. Could, but it just means that things are pretty stretched, right? I mean, it's been a pretty good indicator in the past. So it doesn't mean get out of the market. It just means we want to be cautious. We want to be thoughtful. We don't want to chase, right? There can be this tendency to want to chase returns, and you really have to, I think, to be cautious with that, because it can suck in. The higher the market goes, the more it can suck people in. So we don't want to get there. We don't want to be there. Well, thank you. I think we're at the top of the hour. If there's no other questions, we will go ahead and sign off. And did another question pop up, Jeff, or no?
Just a comment. Great show. Thank you.
Okay, great. Appreciate that. And if you have questions you don't want to, send through the chat or the Q&A, you can always email us directly. Josh at 4J Wealth, Jeff at 4J Wealth, or you can just do the info at 4J Wealth. So thank you very much, and we'll see you guys next month. Bye-bye.